Bear Stearns is at the centre of America's subprime mortgage crisis. Now it's the focus of public anger.
Families, that's who you need to bail out if there's any bailout to be had.
For the government to bail out Wall Street is the wrong solution. That we have people and families that are in trouble. And if there's any bailout to be had, that's where it needs to be.
The US Federal Reserve plans to guarantee around $30 billion of Bear Stearns assets to assist the stricken bank's sale to JP Morgan. Australia's central bank governor argues that's not a bailout, but warns that policymakers need to be careful of unintended future consequences.
Private entities, banks and others might become so confident that liquidity risk has been removed that they end up taking more of various other sorts of risks instead.
But investors are more concerned with the risk that's already built into the system. Citigroup fell 5% overnight after agreeing to pay $1.8 billion to settle claims from Enron's creditors. JP Morgan and Bank of America also suffered heavy losses after a gloomy outlook from Germany's Deutsche Bank. But the RBA says it's a different story in Australia.
Profitability is strong, capital is sound. There's very little direct exposure to the US subprime problems in particular, but the main reason for resilience is a strong economy, sound regulatory framework and I think pretty good risk management.
In its half-yearly financial stability review, the Reserve Bank says households are in sound financial shape, but the RBA expects an increase in arrears because of aggressive lending prior to the credit crunch. Business balance sheets are also healthy. Arrears rates remain relatively low despite a sharp repricing of corporate debt.
The banks are in fact very well placed now to mop up a lot of business that they wish to do with the weaker lenders, particularly in the mortgage market, falling by the wayside.
Despite the RBA's reassuring words, local banks struggled on the market today. Babcock & Brown fell 5% after expanding its corporate debt facility to $2.8 billion and issuing $200 million worth of shares at a 9% discount to yesterday's price. Among the retail banks, only the National posted a gain on news of a $725 million note issue.
I don't think confidence is likely to improve in banking or business at any stage in 2008, and if global credit markets remain unsettled into 2009, which seems to be the consensus, then it's hard to see where credit growth is going to come from.
And the Sheet's Ian Rogers says that banks are bracing for more troubled loans.
We're already seeing credit quality problems in business banking amongst them, prominent listed companies, some top-end companies. But what will probably happen is that bad debt problems will escalate in the middle market and amongst small businesses later this year.
Local authorities continue to review procedures to handle crises, like the UK government's rescue of Northern Rock Bank. One recommendation is to give the Australian Prudential Regulatory Authority power to arrange the takeover or transfer of assets from a failing bank. Glenn Stevens acknowledges that a lot more needs to change before banks return to favour.
Investors will want a reasonable degree of confidence that the bulk of the losses in the most important institutions have been accounted for and disclosed, that remaining excess leverage that might be in the system has been or is well on the way to being essentially sorted out.
And just how far along the banks are in that process will become clearer when they report earnings in early May.